So this is bad. This might be one of the most obvious signs that the U.S. economy is in a lot more trouble than we thought.
President Trump has fired the Commissioner of Labor Statistics after today's weaker than expected jobs report. He's accusing her, without evidence, of falsifying the data ahead of the 2024 election to help elect Kamala Harris and calling today's report into question.
Breaking news. The new jobs report and the president's tariffs are dragging down U.S. markets at this moment.
In early summer 2025, the government told us the jobs market was still growing. They reported that the U.S. added 144,000 jobs in May and 147,000 more in June. Now, to put this in context, the U.S. needs to add somewhere between 80 to 100,000 jobs per month just to keep up with population growth. But just a couple days ago, the Bureau of Labor Statistics came out and quietly changed those numbers. Now, that's not that big of a deal. Revisions happen all the time as the government collects more data, but this revision was huge. May's jobs numbers went down from 144,000 to just 19,000, and June was revised from 147,000 down to only 14. Combined, that's over 250,000 jobs erased from existence. This was one of the biggest 2-month revisions since the 2008 financial crisis, and it's second only to 2020. And if you actually exclude the jobs added in healthcare and government, which accounted for almost all the new jobs for July, then the private sector actually saw a net job loss. Now, why is that such a big deal, right? It's a big deal because in a lot of recessions, the first sign is not a stock market crash or a wave of layoffs. Instead, it's a spike in unemployment. And now the Federal Reserve is looking at a very different picture of the US economy than we thought, which also partially explains the US stock market and Bitcoin and why a lot of other investments are probably down right now. So in this video, we're gonna look at what's really going on, why the jobs numbers were so wrong in the first place, and what the government tells us was their reason why. And then I'll explain some of the more interesting theories as to why it might have actually happened. I also want to talk about the recession, the Federal Reserve, interest rates, and what I'm personally doing with my portfolio and how I'm preparing for all of this. So with that said, let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the jobs. Now, here's why all of this is so important. Take a look at this chart right here. This is directly from the Federal Reserve's official database. Each one of these little shaded areas right here represents a recession. And what do you notice right before or during every single one of them? There's a spike in unemployment. From the 1970s oil shock to the 2008 financial crisis to the COVID crash in 2020, the pattern is almost always the same. The job market starts to break, unemployment starts to go up, and then all of a sudden we find ourselves in a recession. Now, right now, the unemployment rate sits at around 4.2% as of July 2025. Now, that's not really something to worry about yet, but when you combine all of that with the May and June job numbers, which show essentially zero net job growth, then it starts to really paint a scary picture. And this is what economists and investors are afraid of. Now, if these 2 months lost us over 250,000 jobs, it makes people wonder, maybe we're already in a recession. And did the Fed miss cutting interest rates? So there's a lot of really interesting theories here, but what seems to be true is that we lost around 89% of jobs in just May and June. And the first question is, what was the reason for how much the government changed their numbers? And here's what they're telling us so far. According to the Bureau of Labor Statistics, these revisions were just part of the normal process. Every month, the BLS gets more complete data from businesses, government agencies, and payroll companies, and they update the numbers as that data comes in. So the story that they're sticking to is the first numbers were based on just early guesstimates of what they thought it would be, and once more employers submitted their info, the revised total came in way lower. They also pointed out to something called seasonal adjustments, which is a statistical model that's used to smooth out things like school activities and holidays and weather and things like that. Now, in theory, these adjustments are supposed to help us see the trend, but in reality, especially in 2025 with changing immigration policies and tariffs and remote work and automation still changing our economy. These models might be completely off. And that's where the real problem is, because the Federal Reserve has been telling us that the labor market is too strong to justify cutting rates.
Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment.
But what if it's not? What if the only reason we didn't get lower interest rates is because the jobs numbers are completely wrong? So the question is then, what might be the real reason that they got it so wrong? Here's where it gets really interesting. Now, before I get into the more nerdy and technical reason why this might have happened, which will put you to sleep, I want to first explain what President Trump said was the reason why this happened, according to him. Because on August 1st, President Trump posted this on Truth Social. And he says that the jobs numbers were manipulated on purpose. Not just recently, but going back to March 2024, when he says that the BLS overstated jobs by 818,000. And again, right before the election in August and September, by another 112,000. Why would they do that, he asks? Because maybe they wanted the Democratic Party to look strong in the economy and win. Now, fast forward to today, and President Trump's argument is this latest downward revision of 258,000 jobs was intentional sabotage, meant to make the economy look weaker under his leadership. That's also why President Trump fired the person in charge of the Bureau of Labor Statistics. Now, here's the thing. Depending on where you get your news from, you probably saw a very different version of that story. For example, when I was researching for this video, I realized there were 651 different news articles from the left, the center, and the right with the same headline. And the breakdown of the bias is super interesting because left-leaning sources described it as a meltdown, saying that Trump was just punishing the messenger without any evidence. Right-leaning sources agreed with President Trump that the jobs numbers were rigged and that this was the right thing to do to restore integrity. And center media reports stayed neutral on the economy without using emotional narratives. So if you want to understand the economy without falling into a political filter bubble, I recommend checking out Ground News, which is also the sponsor of today's video. Ground News is a platform that I personally use to see how every side is covering the same story. Just go to ground.news/JIC or click the link in the description to get 40% off the Vantage plan, which is what I use to research my videos. So now let's take a look at the real reason that I think the government got this so wrong and why the truth might actually be a little bit more boring than the conspiracy. So if you're still here, congrats, you've officially made it to the very boring part. But here are the two most likely explanations for what really happened. So there's something called seasonal adjustments, and there's something called the birth-death model, which sounds really depressing, but it's not what you think it is. So first, seasonal adjustments. And the idea goes something like this. The job market has predictable patterns, like teachers go on summer break, stores hire for the holidays, construction slows down in the wintertime, so the BLS runs the jobs data through a statistical filter to try to remove the noise and show the trend. But here's the problem. The world isn't predictable in 2025. Because in 2025, we got remote work, AI displacing jobs, aggressive immigration policies, tariffs disrupting entire supply chains. So if you're using a model that's based on what the labor market looked like a couple years ago, then it's going to give you numbers that are not representative of reality in today's world. Now, the second problem is the birth-death model. And this is where it gets a little weird because you see, the government doesn't track in real time how many small businesses open or close every month. It doesn't have the resources to do that. So instead, they guesstimate. They're like, well, based on past trends, a certain number of new businesses are going to be created and they're going to be creating new jobs. The problem with that, though, is what if that assumption's totally wrong? In a high interest rate environment like the one that we're in right now, it's very possible that more businesses are closing than opening. But their model might still be adding phantom invisible jobs to the total because of these bad assumptions. And when the BLS finally gets the real data from tax filings, updated surveys, they're like, just kidding, we didn't really add any jobs in May or June after all. So for now, that's probably the most likely explanation instead of some deep state reasons. I guess we'll know at some point maybe, but I think the real problem is not what the real reason is. The real problem is that the tools we're using to measure the economy are fundamentally outdated and they're wrong. It almost makes me want to believe an insider deep state because that's less of a consequence. But if our economic models are wrong, the biggest question then is, what does this mean for the Federal Reserve? Because the Fed uses these job numbers to decide what to do with interest rates, how expensive it is for us to borrow money. And if the job market is way weaker than we thought, well, that changes everything. And here's what it really changed. This right here. This is the CME Fed Watch tool. And for the several years that I've had it on my channel, it has never been wrong in its prediction of interest rates. And right now, it's predicting a 90% chance that the Fed will start to lower rates by at least 1/4 of a basis point. That's the first major change. Now, the second one is the July jobs report, which is the most recent one we have on file, and it came in at only 73,000 jobs added. That's not only way lower than expectations, that's the lowest monthly number since the pandemic. And after what we just learned, you kind of have to ask yourself, is 73,000 jobs actually 7,000 jobs later once it's revised? So if we're consistently coming in below the numbers that we need, which is 80 to 100,000 jobs just to stay flat, that means the job market is actually getting smaller. And when that happens, these happen, recessions. And believe it or not, the Fed actually knows this because at their July meeting, there were two Fed governors, Christopher Waller and Michelle Bowman, and they actually disagreed with the majority of the Fed because they wanted a rate cut at that meeting, arguing the labor market was actually showing signs of stress. One of them said that once the expected revisions come in, job growth will be a lot smaller than we think.
Governors Waller and Bowman continuing that tradition of explaining their dissents on the Friday after the meeting. And they're both saying why they wanted or preferred a 1/4 point rate cut.
Which is, as far as we know, was exactly right. And that changes the equation for the Fed. Because remember, the Fed has a dual mandate, meaning they've got two goals: to keep inflation under control and to support maximum employment. So if inflation is cooling, and it is, and now that the labor market is slowing down, then they have more than enough reasons to start lowering interest rates. And Wall Street, the stock market's already betting on it. And that's the CME Fed Watch tool I just showed you, which you can check yourself. Having said all that though, here's what I'm doing and how I'm personally preparing for the market. So the first thing that I noticed is after the news came out, the market went down across the board. And that's because the market did exactly what it always does. After the bad news comes out, they panic, they sell, and then they're like, wait, but what happens after this? The Fed comes in to save the day, right? And they try to front run the Fed and get ahead of it. Now, if the markets are up by the time you're watching this video, that's probably why, and the bad dip might have already happened, and now we're pricing in a recovery. Now, for me personally though, I'm not a reactive investor like that. I try to understand the economy so that I don't panic, but I generally don't make decisions on my predictions because even if I'm right once, I'm never right twice at the perfect time. That's why I'm doing the same thing I've always done. I'm dollar cost averaging into the broad market. I'm not going all in on anything right now. I'm not selling anything, but I am paying close attention to the next Fed meeting, and I'm building up a little bit more cash than usual just in case we see a bigger pullback. But I'm also watching Bitcoin closely, and if the Fed does cut rates, that could weaken the dollar, and it could send risk assets like Bitcoin much higher, but only if the economy doesn't fall off a cliff. So I'm just trying to understand instead of overreact, because if the jobs numbers are really right, then maybe we didn't get the soft landing that we were promised. But who knows, maybe President Trump is really onto something. Personally, if I was the president right now, I would not be fighting this data. I'd be like, yes, the economy is indeed bad. Jerome Powell, lower interest rates. I would just swallow my pride and let it happen. But I'd love to know your thoughts. Let me know down in the comments below. And as always, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next week. I'll see you soon. Bye-bye.